Oh, Good afternoon, everyone. I'm Ndongo Samba Sylla from Senegal, Rosa Luxembourg Foundation. I will talk about topic a colonial relic which has been left, let's say, unaffected by all the major economic and geopolitical developments of the last 8 decades. So I want to talk about the CFA franc, the currency used in most of the Francophone countries in Africa. So I have a brief introduction. Uh, Part one, I will try to explain why the CFA franc, this colonial currency, still exists. Part two will be a brief economic assessment and a conclusion about what alternatives to the CFA franc. Okay. 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 So the CFA franc is a acronym for currency born in 1945 during colonial times. Originally, the acronym CFA franc meant the franc of the French colonies in Africa. It circulated in the sub-Saharan Africa part of the French colonial empire. So it was created in a context just after the Second World War, where France was ruined. There were many shortages, high increase in price levels, lack of foreign exchange, and the French currency had to be devalued vis-à-vis the US dollar and the British pound. And until then, there was something called monetary unity that was prevalent, let's say, in the French Empire. Monetary unity meant one empire, one currency. And so the French currency circulated under different exotic forms throughout the empire, except from some parts of it. In that context, there was one technical question that arose, and it was whether the French currency should be devalued using a uniform rate of devaluation throughout empire, or should we have different ways of devaluation to take into account that the impact of the Second World War had been uneven according to territories. And so the second option was secretly chosen by the French provisional government. And this devaluation of the French franc at that time gave birth to the CFA franc, officially created on December 26, 1945 by the provisional government of General de Gaulle, at the same time as the Pacific franc, which is still used by three non-sovereign territories under French domination. And at its birth, the CFA franc had a very shocking parity against the French franc. One CFA franc equal to 1.70 French franc. And 3 years later, the French franc was devalued, and we had one CFA franc equaling 2 French franc. And this was not the kind of, let's say, situation you would observe, let's say, in British colonies, where the external value of the colonial currencies were more in line with their economic characteristics. But France chose to give her colonies an overvalued currency, because it was a way for the French economy to reconquer the trade share it lost during the Second World War. And as you know, when you have an overvalued currency, this is a way of subsidizing imports and also handicapping exports. And France at that time was not that competitive to, let's say, to face international competition. France wanted to have access to raw materials and also have access to captive markets. And the CFA franc was instrumental in that context. So now currently, you have two monetary blocks, each using the CFA franc. You have the West African Monetary Union bloc, and you have also the Central African Union bloc. So for West Africa, you have 8 countries: Senegal, Mali, Burkina Faso, Niger, Cote d'Ivoire, Togo, Benin, and Guinea-Bissau, which joined them in 1997. Guinea-Bissau was a former Portuguese colony. In Central Africa, you have Chad, you have Central African Republic, you have Cameroon, Congo, Brazzaville, Gabon, and Equatorial Guinea, which joined them in 1985. Equatorial Guinea was a former Spanish colony. And since its creation in 1945, the CFA franc rested on 3 main pillars. and two counterparts. The first pillar is the fixed peg to the French currency. So that means the fixed peg to the French franc until 1999, and since then is the fixed peg to the euro. So the fixed peg is working to eliminate exchange rate risk between the CFA franc and the French franc, the French currency. The second principle is the free transferability. That means the free movement of capitals and incomes between the CFA franc countries of the same monetary union and between each monetary union and France. The third pillar is a pompous term, convertibility guarantee by the French Treasury. So the convertibility means that the French Treasury promises to lend its own currency whenever the central banks are short of foreign exchange reserves. So that's the meaning of the convertibility guarantee. And as a counterpart to this convertibility guarantee, there is first the obligation for the central banks, for the two central banks, the central banks for each monetary union, to deposit a proportion of its foreign exchange reserves at the French Treasury, not at the Bank of France, but at the French Treasury. And it was 100% after the independencies, and it had been lowered to 50% since the mid-2000s. And the second counterpart is that the French government is represented in the organs of both central banks with implicit veto power. So that means that the French Treasury is in charge of monetary policy and exchange rate policy in the two CFA franc blocks. Another evolution is that since 1999, with the abandonment of the French franc for the euro, the CFA franc is under the double legal tutelage of France and the Eurozone monetary and political authorities. For example, if the CFA franc has to be enlarged, the European Union Eurozone authority must be informed. And if the CFA franc has also to be devalued, the Eurozone authorities must also be informed. In this, you will see that the meaning of the so-called French guarantee, because they are using this trick to make people believe that the French are bringing something into, let's say, this monetary union to guarantee their so-called currency, you know, and many people think that another country could guarantee your currency. And if you look at this budget, you have 3 lines because it's a budgetary agreement, and every time you have 0 because the French government never expect to provide, let's say, loans to the central banks, because mechanisms are designed so that there will never be the need to have access to French loans, because they have a system of, let's say, of alarm. If the foreign exchange reserve represent, let's say, less than 20% of the liabilities of the central bank, they will stay austerity, no more, let's say, monetary policy that could be expansionary, etc. So this French guarantee is a scam. So why does CFA franc still exist? One of the reasons is that the Francophone countries did not have a proper independence. Because all the other countries, they have a proper independence, because when they had their independence, well, they started to get rid of to exceed the colonial monetary blocks, which they were part of. For example, you had the Sterling area, the Belgian monetary zone, the Escudo zone, the Peseta zone, and all the countries that got their independence, they exited from the colonial monetary blocks. But in the case of the French, in fact, they anticipated that the decolonization would be inevitable, and so they negotiated a kind of conditional independence, saying that, well, we will grant you independence, but if you accept to not be sovereign in sovereign domains, like, for example, foreign trade, foreign affairs, external trade, currency management, defense, strategic raw materials, etc. So they signed with, let's say, the African leaders at that time, something called cooperation agreements. And cooperation agreements was a way of saying that you will be formally sovereign, but in real terms, you will have no sovereignty over sovereign domains. And for example, you could see some examples of cooperation agreements, for example, signed by the Gabonese authorities the day of their official proclamation of independence. You could, for example, read, the Republic of Gabon commits to facilitating the storage of strategic materials and products to the benefit of the French armed forces. Should it become necessary for security reasons, it also pledges to limit or prohibit exports to other countries. And this was signed the day of the official proclamation of independence of Gabon. For Congo, Chad, and Central African Republic, you could also read that the states of Equatorial Africa confirmed their membership of the monetary union, of which they are members within the franc zone. All the revenue and expenditure operations of the states of Equatorial Africa will be made via the transfer or purchase of foreign currency on the Paris foreign exchange market. And all of this was written and signed by the African leadership at that time. And so there was a letter by the French Prime Minister at that time, Michel Debré, to its Gabonese counterpart in July 1960 to explain the principle of this conditional independence. He said in that letter, we grant independence on the condition that the state, having gained its independence, endeavors to respect the cooperation agreements. The one does not go without the other. Most of the Francophone countries got their independence in this way. And as most of them were trained in France, and some of them were even members of parliament in France, so they accepted to sign these agreements, all of them, except for Sékou Touré, who was a Guinean trade unionist, and also the president of Guinea at that time, who demanded the independence of Guinea, which he obtained through a referendum in 1958, 2 years before the other African countries got their independence. But there was also a story of imperialist repression. When Guinea decided to have its own national currency and to exceed the CFA franc, the French retaliated with something called Operation Persil. The French secret services inundated the Guinean economy with counterfeit banknotes they themselves printed. In 1962, Mali exited from the franc zone, but its neighboring countries like my country, Senegal and Cote d'Ivoire, they decided to put trade barriers against Mali, which is a landlocked country, in a way to say that, well, if you want to leave, you will have to pay dearly. In 1963, there was a Togolese leader, Sylvanus Olympio, who was killed days before the launch of the Togolese national currency. And when he was killed, there was no longer any project of having a national currency for Togo. In 1987, we had the murder of Thomas Sankara, the revolutionary leader of Burkina Faso. It wasn't linked to the CFA franc, but it was linked generally to its anti-imperialist stance. In 2011, there was also a sabotage by the French and African allies, because the French were siding with Alassane Ouattara, who was an economist at the IMF, and they decided to organize a financial embargo externally and internally. When I say internally, that means the government did not have access to its own account at the central bank, and also own access in the domestic banking system. They recently did the same thing with the Malian government, because there had been a military coup in Mali, and the new military regime, they wanted to get rid of the French military presence. And when they decided that, they was also cut off from the international financial system, but they were also cut off from their own banking system. They could not have access to their own central bank. So when you are in a monetary union, you don't have formal monetary sovereignty. So you could face some kind of sabotage. That means they could cut off you from the international financial system, but when you have your own currency, that is not possible. So briefly, an economic assessment of the CFA franc. What are the benefits that France reaped from the existence of this currency? And there have been a relatively honest report made by the French Economic and Social Council in the 1970s that explained the logic of the benefits reaped by France by maintaining this CFA franc currency. The first advantage is that France could pay its imports from franc zone countries in its own currency. This is the equivalent of the exorbitant privilege of the US dollar. That means that France could buy all the goods and services in its own currency. And at the time, the French currency was very weak. It was regularly devalued. And so the existence of the CFA franc was a way to strengthen the value of the French currency. The second advantage was that the French companies operating in the zone benefited from large and stable outlets for trade. The third advantage was that, well, they had a trade surplus with regard to the franc zone countries, which also provided France with exchange reserves because the Francophone countries had surpluses vis-à-vis the rest of the world. The fourth advantage was that, well, as the French Treasury is responsible of the monetary exchange rate policy, the French companies have the guaranteed freedom to repatriate their revenue at capitals without any foreign exchange risk and without any transfer risk. That means there is always be enough foreign exchange to allow for the transfer at a fixed rate. And the last advantage is that France enjoys a system of political control serving its own economic interests that doesn't cost it anything, since its supposed convertibility guarantee has rarely been put into effect. In fact, what often happened was that African central banks received negative interest rates. That means the nominal interest they received had been generally lower than the rate of inflation in France. And that's why it is a system that is not costly for France. And besides France, also African elites benefit from, let's say, cheap imports and also the ability to have their assets in hard currency abroad. And there have been some speculation about the benefits reaped by African countries using the CFA franc. But sometimes one argument for monetary union is that there are more trade between the members of the monetary union. This is not the case in the Francophone. You see that the trade within the countries of the Francophone is just 10% of their whole trade, external trade. And in Central Africa, it's just 5% of their external trade. Sometimes they say, as you have low level of inflation and a fixed parity, fixed peg, so this could attract investor, but that is not the case. If you take the case of West Africa, you see that Ghana, which has a floating currency regime, had a stock of foreign direct investment higher than all the 8 countries using the CFA franc in West Africa. Sometimes they say, well, they have low inflation and exchange rate stability. Yes, that's true, but this has had important economic cost, as we will see, because there had been no long-term developments. If you look at this table, you will see that my country, for example, Senegal, has been the world champion in terms of, let's say, inflation rate, 1.3% between 1996 and 2019. That means Senegal has outperformed France, Germany, China, the US, Malaysia, Korea, Brazil, India. There is only one country, Japan, except Japan, we are the champion, because this is a very deflationary framework. And one other interesting statistic is the current account balance of West African Monetary Union. In the World Bank statistics, you don't have, let's say, complete series, but for this period, you have the complete series. And you see that there had been chronic trade deficits, chronic current account deficits. And one of the reasons for these trade deficits is that the currency is overvalued. So that means it's cheaper to import than to produce. You see, the other thing is also, how could you have 6 decades of current account balance deficits and having a fixed peg? In fact, you could have that only through strengthening financial dependency. That means you have to issue debt in foreign currency and also attract foreign direct investment. The other way is also to ration productive credit domestically. In the Francophone, you have very low levels of inflation, but you have two-digit nominal interest rates in the Francophone. Bank loans are very short-term. For example, in my country, 75% of all bank loans had a duration of less than 1 year in 2019, and 45% had a duration of less than 1 month. And the bank loans are not targeted to agriculture and industry, but mostly to trade and services. And you could see that the primary sector, which employs, let's say, more than half the population, received, let's say, an amount of credit that was lower than the amount of credit the central bank granted to its own employees. You see, so that clearly shows the class dimension of this currency arrangement. And you see also that the banking system is highly dominated by foreign banks. 90% of banking assets in Senegal are controlled by foreign banks. And the result of all of this is that there has been a long-term economic decline or stagnation in the Franc zone. If you take, for example, Niger, you will see that Niger achieved its best level of real GDP per capita in 1965 with less than 900 US dollar, constant dollar 2015. And you will see that Niger's GDP per capita in 2019 was 42% lower than its best level of real GDP per capita it achieved in 1965. You take the case of Cote d'Ivoire, which is the biggest economy in the Franc zone, Central Africa and West Africa, and you see that Cote d'Ivoire achieved its best level of real GDP per capita in 1978. In 2019, its real GDP per capita was 30% lower than this best level it achieved in 1978. This has been, let's say, the pattern in the CFA Franc zone. If you take the case also of Central Africa, you have the same pattern. So in conclusions, what are the alternatives to the CFA Franc? Because there have been many protests against the French monetary colonialism. So people are going to the streets to say that we no longer want French military domination. We no longer want French monetary colonialism. We could see five, let's say, options to end the monetary status quo. The first is what I call symbolic reformism. That means changing the name CFA Franc, having banknotes and coins manufactured outside France because banknotes and coins are still manufactured in France, and even first reducing the deposit rate of foreign exchange reserves at the French Treasury. This is the option championed by Emmanuel Macron, and they had something called a reform in 2019, but yeah, it doesn't affect, let's say, the pillars of the CFA Franc. The second option is what I call adaptive reformism. There are people like, for example, Dominique Strauss-Kahn, the former managing director of the IMF, saying that we should make the CFA Franc parity more flexible, and we should also Europeanize the management of the CFA Franc by having European representatives instead of French one, and having a so-called European guarantee. The third option is what I call neoliberal abolitionism, and it consists in replacing the CFA Franc by a larger regional monetary union of the Eurozone type. In West Africa, there is a project to have a single currency for the whole region, and it is a kind of a replica of the Eurozone. I have many Pan-Africanist friends who think that this is an alternative to the CFA Franc, but it could be worse for me than the CFA Franc because it would have all the defects of the Eurozone without the level of financial and trade integration achieved by Eurozone countries. The fourth option, which is my champion option, is what I call sovereign abolitionism with solidary national currencies. That means that every country should have its own national currency, its own central bank, and we should have a mechanism of monetary cooperation between the different national currencies. For example, having a partial pooling of foreign exchange reserve, regional payment settlement system, and common food and energy policies. There's a last option, it's the Bitcoin. And actually, the Republic of Central Africa decided unilaterally to opt for Bitcoin. There have been some African economists who are also very critical of the CFA Franc and who champion also solidary national currencies, Samir Ramin, for example, and also a less known economist, Joseph Chiang-Kwemi, who was an economist at the IMF and who resigned. He called the IMF Instant Misery Fund. And yeah, he was also very critical of the CFA Franc and advocated a kind of solidary national currencies. So thank you for your attention.